in 3, 2, 1. What is up, Jerry?
All right. This is
We
going
are
to work
remote
better
again.
this time.
We're in two different places.
Remote again.
Yeah.
Yep.
Yeah.
Yep. I understand it's pretty chilly up there.
Yeah, 17 degrees, man. Don't come home.
Yeah. No, it's a little rainy, a little stormy down here, but I cannot complain. It's definitely not 17. Closer to 70 than 17.
Yeah, that's much nicer. Just switch the number, 71 or 17. I'll choose 71 every
Exactly.
time. All right, man. What we got this week? Talk to us.
All right. It was a rough week for the market. We'll get to that in the charts at the end, but first I want to go over a few things. So everybody has heard the term bull market, correction, and bear market. We're going to talk through what exactly those mean and do the labels even really matter. Then IBD, Investors Business Daily put to call ratio, a really valuable tool if you subscribe to Investors Business Daily.
Which we highly recommend.
Which we do highly recommend.
And we are not sponsored in any way. Oh, I wish we were sponsored by somebody.
Yeah, but IBD would be a good sponsor.
Yeah, IBD, it's great. We use it all the time.
Yep. Bonus chart ordinarily is one stock chart or ETF that we do, but this week is going to be the FAANGs. So if you're familiar with that term, it's Facebook, Apple, Amazon, Netflix, and Google. Those make up what they call the FAANGs. They are the companies that have been driving the C fund higher for the past, all of 2021. They're also the ones that are leading us lower right now. So we're going to take a look at their charts, then the 2-year weekly charts for the TSP funds. Okay, so generally speaking, the Wall Street Journal, right, among other financial news media outlets, refers to, uses this 20% threshold as a rule of thumb to label either a bull market or a bear market. So they call a bear market when an index or an ETF falls below 20% from a previous high. Or a bull market, they say, is in place when prices have risen 20% from a previous low. Okay, so that's generally how bull markets and bear markets are laid out. Key things about a bull market, right? They're typically designated by media outlets as a rise of 20% or more from a near-term low. And so just so you know, I'm not making this up, right? This is the Investopedia definition of what a bull market is. So you can go to that link and it'll give you a whole lot more details. I'm just kind of taking away the highlights. So designated by media outlets as a rise of 20% or more from a near-term low. Likewise, a bear market is called when an asset falls 20% from a previous high. These heuristics don't make sense in practical terms, and we're going to show that on a chart in a minute. Calling a bull or bear market often requires a degree of judgment, as well as considering the condition of the broader economy and market psychology. So,
right, it's a little subjective, right? I mean,
yes,
it's got some rules to it, so it's not fuzzy or gray, right? Everybody's kind of agreed on the rules, but if you listen to one analyst versus another, what they might when they might change from bull to bear might differ.
Yes, they talk about the sort of the underlying market conditions and the circumstances, and in conjunction with the label of a 20% move one way or the other.
Right.
And then it depends on the time frame you're looking at.
Yeah, the why could be different depending on the analyst you're listening to, right?
Oh, for sure. Right.
Yeah.
And the question really is, does it matter? Like if we are in a correction or in a bull market or in a bear market, does it mean, what does it mean in the big scheme of things? And we're going to show it on a chart.
I think that's the larger takeaway, right? When we're talking about bull versus bear and what, if you're following us and watching our content or one of our subscribers, you know that we live by the trend, right? We want to see the long-term trends. And so the fact that it's already a bull or a bear market isn't very helpful, right? It's more helpful to know which way the trend is going, right? Not where we are, but where is it going? And so we're
you want to see it as, for sure. I mean, you want to see, for the most part, certainly the Fang stocks were going up, were trending up in 2021. As you look at the charts, and we're going to get to it, you can see that that trend is changing. So if you can identify the change in the trend as soon as possible, and in this case, get out of it, you maintain your principal, right? You're not losing any money on a relative basis. You're not going to call the top because you have to see the trend change. But
Right.
would you wait until we're already in a correction, meaning down 10%, or already in a bear market, meaning down 20%, before you say, okay, well, now I need to make a decision, right? Ideally not. Ideally, you'll make a decision when you see the actual trend change on the price chart.
Right.
Right. So in the simplest definition, like we said, rising prices signify a bull market, while falling prices signify a bear market. So you might think it's pretty easy to determine what type of market we're going through at any given point in time, but it's not as easy as it looks, basically because it depends on the time frame that you're looking at. So for example, an investor looking at a 5-year price chart will have a much different opinion about the market than someone looking at a 1-month price chart, right? So if you look at a 5-year price chart of the S&P 500, it's going up. It's in an uptrend, clearly. But if you look at a 1-month price chart, everybody's been clobbered. I mean, it completely depends on the time frame that you're looking at, and you have to be able to kind of switch hats between those time frames. So, okay, let's say the stock market's been rising for the last 2 years, allowing an investor to argue that it's engaged in a bull market because the prices have been going up for 2 years. However, the market has also been pulling back for the last 3 months. Another investor could now argue that it's topped out and entered a new bear market, right? So when they make these kinds of observations, they're not taking into account the 20% label. They're saying that as long as the trend is up, we're in a bull market. When the trend changes, we're in a bear market. So when people say bull or bear market, they're not necessarily referring to that 20% label. Okay. So a correction. Again, Investopedia. In investing, a correction is a decline of 10% or more in the price of a security from its most recent peak. Corrections can happen to individual assets like stocks or bonds, or to an index like our C fund that measures a group of assets. An asset, index, or market may fall into correction either briefly or for a sustained period, right? Days, weeks, months, or longer. However, the average market correction is short-lived and lasts anywhere between 3 and 4 months. So the corrections that we've seen, certainly since the COVID low, we've had several on the NASDAQ and a few on the S&P 500 that were 10% corrections. And all of those were opportunities to buy the dip. The sentiment, the investor sentiment, was still very positive. People looked at a correction as a chance to buy shares cheaper, and that's the buy the dip mentality. And we would come down to a support level, and the market would turn back up. So we didn't really have any, even week-long corrections for most of the past year or so. We certainly didn't have any months-long corrections. That's kind of changing now. So key takeaways for a correction: the idea, it's a 10% or more decline from a previous high. Corrections can last days, weeks, months. While damaging in the short term, right, because you're taking the market's down 10%, a correction can be positive, adjusting overvalued asset prices and providing buying opportunities. So again, this is the idea of buy the dip. It's providing buying opportunities. A bear market, by the Investopedia definition, right? A bear market is when a market experiences prolonged price declines. It typically describes a condition in which securities or our funds prices fall 20%, so 20% or more from recent highs, amid widespread pessimism and negative investor sentiments. So the big difference that you see in the news and just people talking around the office, when you're in a correction, people aren't worried. They're, the market's down today, no big deal. It's been down for a couple of days, no problem.
They're usually telling themselves
support level will come back.
whatever excuse they can, right? I mean, in their head, right? If you're sitting at the water cooler and we're during a correction versus a bear or bull, you're just kind of like whatever it is you've heard is the reason. It's kind of what you're regurgitating usually.
Right, right. And it's to be expected. I mean, that's most people aren't looking at a price chart and drawing lines in the sand really and trying to identify changes in the pattern.
Yeah, and I point that out, not to be. I mostly point that out because what we hope our followers and listeners and members are doing is not that, right? Is not taking. I mean, not even what we say and regurgitating it at the water cooler. Go look at the charts,
Right.
and then you'll have your own opinion, right?
Right. 100%.
We're a media outlet just like anybody else, right? We're here talking heads. We got our opinions. We try to show you where our opinions come from. That's a little different, right? We try to give you the charts and all that. But at the end of the day, what we're hoping you guys will do out there is go look at these yourself. And then when you're sitting around the water cooler or the chat room or whatever it is, right, the virtual version, you'll have an educated opinion and you'll know why this is happening, or at least be able to explain why it might be happening.
Yeah. Yep. I don't know any other way that you can make really sort of tactical decisions in managing your TSP without looking at price charts. I just don't, I know there are other ways to play the game, but for me, it's the only way, the only thing I can see and project forward. So we'll get into it when we get into the charts. Okay, so key takeaways for a bear market. Prices decline 20% or more, negative investor sentiment, declining economic prospects. Kind of the situation we're in right now. Bear markets can be cyclical or longer term. They can last for several weeks, a couple of months, or they can last for several years or decades. Short selling, put options, and inverse ETFs are some of the ways in which investors can make money during a bear market as prices fall. We cannot do those things in TSP. All right. So here's an example of sort of all the things we just talked about a bull market, bear market, or correction. The chart, this is a chart of the C fund from the high right before COVID to the COVID low, and then some of the recovery rally after it. Okay. So we hit a high of about 3,400 in mid-February 2020. The market gaps down, right? So people start paying attention on big gap downs, but this move isn't inconsistent with this move. So it's not that big of a deal yet, right? By the time we get down to this day right here, right, on this gap down and this day, it put us in correction. So again, what's a correction? It's 10% off the previous high. So all I did was take 3,400 and multiply it by 0.9 and get 3060. So now once price hits 3060, we are labeled in a correction. If you were a subscriber back at the time, and you can take a look at the alert that we put out in mid-February at some point. We got out of the C fund. It was this day right here. We moved to 50G, 50F on that day. And you can read the alert. You can read about why we did it. It had nothing to do with COVID. It had to do with actually with this low intraday getting below this pattern right here. So
yeah,
had nothing to do with COVID. We weren't.
I think that post is it's actually public now because it's far enough back.
It's in smart reading. Yeah.
Yep.
So on this day, we get down to correction, right? And I'm sure it was all over the news media at the time. The very next day, we do a negative reversal, right? We opened down here, came all the way down to the low for the day, and then closed at the top of the day's trading range. And then the next day, we had a big move higher, had a correction, and then another big move higher, and that's where it stopped, right? So that's called a recovery rally. Then the market kept going lower. So now we have 2 points. Now we have the top and we have another point and we can draw the line and extend it down. Okay, so this is the trend line. So that's how you're forming the downtrend line. By the time price continues down to this day, they say we're in a bear market. And all I did was multiply 3,400 times 0.8, and you get 2720. So now we're technically labeled in a bear market. Did that change anything that we did in terms of making reallocation decisions? No, because the price keeps going down, right? We had a recovery day here, and then the next day it came down. Recovery here, lower lows, right? It keeps going down until we hit this bottom. Then we have a huge rally off that bottom. Now, do we know this is the bottom? Absolutely not, right? All of these could have been the bottom, but they weren't. There's no way to know that. So if you're trying to decide when to get back in, for me, I'm looking at the trend line. So I drew this trend line. On this day, we got barely outside. Then we had another down day. Then we were another bigger down day, and we're back below the trend line, right? So it's churning all around this trend line. On this day, we gapped up and we closed 20% above this low, right? 2640. So all I did, multiply 2200 by 1.2, and now we're in a new bull market as of this day right here. So the label would say we're in a new bull market. That's also the first reasonable day to get back into the market, because all this churning on the trend line means we don't know which way it's going to go. Could it have kept rolling over? Absolutely. This was the first day of a new, we could really identify of a new rally to get back in. So you could say, yeah, but you didn't get this 20% gain, right? It was 20% from the low to where we could reasonably get in. That's true, right? You can't time the tops and bottoms. We're trying to follow the trend. So once that day was in, the market kept going, and as we know, really took off. So kind of the point of all this is, whether we call it a correction or a bear market or a new bull market, has nothing to do with making reallocation decisions. The way to do it is to look at price and see how it responds at different levels. Draw the trend lines, and your best chance of the market moving higher is when it breaks to one side or the other of those trend lines. So don't get hung up on the labels. That's the bottom line of this chart. Don't get hung up on the labels. Okay. Investors Business Daily. Again, this put call ratio is a great tool. It's a contrarian sentiment indicator. So what that means is, a put is when investors are betting that the market's going to go down, right? That's what that means. If you buy a put, you're betting that the index or the stock or whatever is going to go down. If you buy a call, you're betting that the price is going to go higher. So they do a ratio of negativity puts versus positivity calls. Okay. And when more people think the market is going to go lower than think it's going to go higher, that tends to identify a bottom. People get very pessimistic at the bottom, right? We've all heard, like, you lose all this money and then you sell it, right? You sell at the bottom because you think the market's going lower, and that generally identifies the bottom. So when everybody thinks that the bottom's going to fall out, the bottom already did fall out. and you can see it on the put call ratio chart. So for IBD, the ratio will surge above 1.0 when investors turn bearish and buy more puts than calls. A reading above 1.15 can confirm a positive reversal in the S&P 500 or NASDAQ, or a follow-through day. So this is the chart as of Friday for the put call ratio. So up here we have the S&P 500, and this line chart is the put call ratio. So you can see back here, for example, we hit 1.0, and it was this low. It was identifying that low. Okay. So you can kind of see anything above 0.8, you have to start thinking you're at a low. Okay. And we saw that recently. Unfortunately, price kept moving lower, and also the put call ratio came down, which basically indicates that the bottom is not in on this current correction, right? Because we're not on the S&P 500 is not 20% down, so we're in a correction. We might not even be actually 10% down yet. We're close, but we're not in a labeled correction yet. At some point when we get to the bottom, the put call ratio is going to be up here somewhere, but we're not there yet. This is just one indicator, but the put call ratio is a pretty good indicator of investor sentiment. So it's definitely something to watch. And at this point, it makes me think that the correction that we're in is not over yet. Okay, so the FAANGs. Facebook, these are the ticker symbols, right, for the Fang stocks. Facebook, Apple, Amazon, Netflix, and Google. They all were driving the market higher in 2020 and 2021.
Pretty sure everything in that list I have on this desk in front of me somewhere.
Yeah, sure. Everybody does, right?
I mean, it's no surprise that those companies are driving the market, but wish it wasn't just those guys.
Yeah, I wish it wasn't just those guys too. For the we say the majority. I think it's 30% of the gains in 2021 on the S&P 500 were from those 5 stocks.
Right.
So 30%.
We don't know
5 stocks out of 500.
Yeah, and we don't know what the mutual fund window is going to allow us to do, but let's just pontificate a little bit, right? And to give people a perspective of like how important this could be, right? So if somewhere in that mutual fund window, whatever version it would be, if we had access to something that followed those FANG stocks in any way,
yep.
Theoretically, if you were watching the trends and you knew that they were pushing the market, you could go 100% there or 50%, whatever, and make your portfolio more focused, and you would have beaten the S&P 500.
Absolutely.
Yeah, you would have done really well, for real, not the real return.
Right.
Yeah, and your risk would have been low. That's the key too, right? Because you would have been following the trend, and not just guessing that they were performing well, and so your Sharpe ratio is going to be low, but your return is going to be huge. And so we're hoping that we can get access to those kind of things, and whatever version that is, that's more than we have now.
Yep, it's going to be very interesting. I mean, for me, I need to see what the rules are going to be for the mutual fund window. It's gonna really make a big difference on how I use the mutual fund window going forward. But
for sure, I'm
not going to do like a deep dive into these all 5 of these charts. I just wanted to kind of point out. So if the FAANGs are leading the market higher, which they were, right? Here's the bottom of COVID. You can see that basically Facebook, I don't really go out far enough, but we had a high here, a high here. I'm not sure where the last previous low was in Facebook, but the channel is basically flat. You could have traded this, along a flat channel before COVID, and then COVID comes along, basically hit the prior low, but then we have a new uptrend now on Facebook. Right? It was clearly a different channel, right? This one was horizontal. This one is clearly moving higher. And now the trend has changed on Facebook, right? It was kind of identified back here when the MACD crossed back in September. So it was sort of forecasted back then. If you had drawn the trend line, so you might have taken this dip on Facebook and used it as a buying opportunity down here, right? To buy at the trend line, to buy when prices are cheap. Once you saw that the trend line is violated and became resistance, right? It was support here. Once it violated it and came down, okay, that's not a problem yet. But now it came on the recovery rally, it couldn't get back above it. So now the trend line becomes resistance, and you can see price keeps moving lower. So there's a change in the trend. Okay, and clearly that's Facebook's contribution to the losses that we've had in the past couple of months. Same thing with Apple, right? Basically, this sideways channel, COVID happens, huge run, consolidation, another big run, and now Apple's rolling over in the last week or so. But this churning is definitely, well, for in terms of Apple, you could draw this trend line and say we're not there yet, right? If you owned Apple stock, you could hold it until it got below that trend line, because right now that's the most reasonable trend line. So it's possible that Apple comes down to 155 and keeps going up. It hasn't broken the trend yet. Amazon, pretty giant break in the trend. We got a pretty clear trend there, and this week Amazon got crushed, and now on a recovery rally, if this becomes resistance and Amazon keeps moving down, that's what you'll see. But Amazon is a big contribution to the S&P 500, and that's a pretty big hit that we took, and that's a big part of the reason why C fund prices are going down. Netflix, obviously. I don't really understand why. I read an article on Financial Times magazine's newspaper. It's a British newspaper. Talked about the concern of what they called contagion of Netflix being contagious, meaning it will seep into other tech-related industries.
It'll infect other stocks.
Yeah, like they talked about contagion in the financial meltdown, right? When Lehman Brothers and Bear Stearns and all that, they all affected each other. And I was reading this article yesterday, and I was kind of chuckling to myself, like, Netflix is going to be the contagion that brings down that causes this new, bear rally that people aren't subscribing to Netflix, and that's going to wreck the economy. It was an interesting article. Yeah. But Netflix, obviously a part of the FAANGs, and was a big part of the drop on Friday. Google, same thing. We're in a huge uptrend on Google since the low in COVID. And this is probably the best example. I mean, we're in a very tight trading range all the way to here. You could say that this decline, it's okay because it's still, we still have higher lows. And here we still have higher highs. But once we had this break in that trend line, things have changed. So whether we call it a correction, a bear market, a bull market, whatever, if you look at this chart and you can identify that this does not look like this, now you have some valuable information. Now you're not just saying, well, if Google's 2,800 and it was up 1% today or down 2% yesterday or whatever, the price moves up and down only matter on a relative basis relative to the trend. So, prices were up and down all the way along, but the overall trend was up. Now the overall trend is different. It's changing. So that's what we're trying to really, technical analysis is about. You can see when price changes and make decisions based on it. And the same thing with Google, like the rest of them, end of September, even though prices continued higher on Google, the technicals rolled over, back here. Okay. The TSP fund charts. So like we always do, the 2-year weekly charts, the blue line is the 20-week exponential moving average line.
For those that may be kind of new, Jerry, give us just a quick recap of why we use these particular time frames, the 2-year weekly.
So there are a lot of ways to play the TSP game, right? You can look at it every day if you want. You could look at it once a week if you want. Most of us have day jobs and we don't have time for all this. And you can't day trade the TSP anyway. It's, with the 2 IFT rules a month, and you have to have your trading by noon to get that day's closing price. For a lot of people, the weekly charts are a better way to do it. You're going to have to allow for some volatility in there, but the weekly support levels tend to be stronger. Support and resistance levels tend to be stronger. So in this case, we have support all the way along here for a month at that 20-week exponential moving average, and then we moved higher. We get support here.
And what I think
here.
it does is, like, where we started with this is where we tell people, not started the show, but like when we originally started this project, we really tried to get people convinced that you can look at this time frame of charts. Right now, it's still helpful to kind of zoom in and out, right? So don't misunderstand what I'm saying. But all things given, if you were to follow to your weekly chart, and once a week you kind of updated it, major trading decisions and went on about your business, that could be it, right? And that's going to serve you well over a 10, 15, 20 year basis, right? Now, is it going to be perfect, day to day? No, this isn't day trading, and we can't make that many moves anyway. So I just like to point that out because it's been a few shows since we kind of discussed why the 2 year weekly, because early on we used some different ones, right? You would kind of go back and forth, but we've really found like this is a good sweet spot, right?
Yeah. I think for the show, this is a great sweet spot if you're a member of the site. We put out a newsletter every weekend, and we get into
a lot deeper,
and much different time frames.
Yeah. Right. Well, yeah, I mean, you're paying for the analysis, right? That's what we do, as we dig into this deeper. So you want to understand, but we also want to educate you to do it yourself. So,
right. I mean, these are definitely the basics, and you can take these basics and do it on your own for sure. And then if you want to be a subscriber to the site, you can, look at our analysis and use that to validate your own decisions. But in this case, what I just wanted to point out, it should be really, really clear. This week is the first time that we have closed significantly below. I mean, we had a close here just barely below that 20-week exponential moving average line, back on really the first correction that we had since the low in COVID. But this is different, right? I mean, you can just look at the chart and you can see it's just different. You also have several weeks of big volume price declines. So the volume scale, the red lines are when prices go down for the week, and the black lines are when prices go up for the week. So what you want to see is, like back here, you got some big volume up weeks that are pushing prices higher, and you have relatively few big volume down weeks. This last couple of months is different. We got high volume down weeks and very low volume up weeks. It indicates a top. I think we talked about that last week. I mean, we didn't need to see this week happen. All we had to see was this one, really, and you're looking for a top. The technical indicators had already started moving down before this week happened. I think we talked about it on the show last week or the week before, or certainly was in one of the newsletters. The divergence of price. So price kept moving higher here, right? Even though the technical indicators had all already rolled over. So you should have anticipated or been on guard for a move down in price. Okay, so now we have the move down in price. Now it's confirmed. The only thing, if you're still in the C fund, for example, the only thing you want to see is what happens when we get a recovery rally. If the blue line, say, continues out that way, we get a recovery rally and hit it, and then continue lower and go below these lows. Now we have a new confirmed downtrend. So while the 20-day or 20-week moving average line was support every time it hit it since the COVID low. Now we're looking for it to be resistance back up here somewhere. We're also looking for a bottom in the technical indicators. So a lot of people are like, okay, great. When do I get back in? One of the things you want to be looking at to get back in is the technical indicators bottom out and then turn higher. That's when you want to get back in. S fund, same kind of thing. I do some of the different support levels in the newsletter this weekend, but we had been talking about 2100 as a really important support level. Back here, 2100 was pretty important. It was tested intraday or intra-week, dipped below that level quite a bit, but on the closes, 2100 was the support level. And then here, most recently, it was also the support level. And this week clearly broke below that support level. So things have changed, right? You don't want to be in the S fund down in here. On the positive side, if we can call it that, unlike the C fund, the S fund is on a weekly basis is already starting to get oversold. Right? The slow stochastic is lower than it was back here at the COVID low. So we should see some kind of recovery rally in the near term, I expect. A recovery rally doesn't mean that we've hit a bottom and we're going to start, going higher, meaning new highs, right? We could, it's certainly possible. But more likely, we had a leg down, some consolidation, we're in a leg down, we should get some kind of recovery rally, and then probably another leg down. The next reasonable support level is right here, these tops. So we're looking at 1700. We'll see how it goes. It was a rough week. It was down 7.58% just this week alone. iFund. We've been talking about the iFund here for weeks, if not months. The iFund has the least exposure to tech. So tech is what's rolling over now, right? The FAANGs are pushing everything down. iFund has the least exposure to tech, which is why it's falling the least. So the iFund is outperforming, but that doesn't mean it's going to go higher as the other funds go lower. It just means it won't go as low as the other funds go because it's not as exposed to tech as much. So you can see it in the technicals. They're rolling over, but nowhere near like the C and the S funds are. The I fund has this really strong support level at 75. We're pretty close to 75 right now. If we get down to 75 and we get support there and it moves higher, great. Based on what the rest of the market is doing, I wouldn't really expect that support level to hold. But until it fails, we're still in this sideways channel on the I fund. And if you need to be in any of the stock funds in TSP, right now the I fund is your best bet. F fund was the only fund that was up for the week, which is kind of ironic because the increase in interest rates over the last couple of months is what is affecting tech right now the most. But we had a low back here in March 2021, and we're testing that prior low right now. So we would have to, if you drew a trend line from this top and you connected these tops, so somewhere out here, the F fund would have to recover and get back above this downtrend line before I would consider getting back into it. We're in a pretty negative triangle right now. Obviously, anything below really this Friday's low. So anything below here, the F fund just continues down. And that's a factor of whether or not the Fed pushes up interest rates. Okay.
Questions.
A lot of stuff in there. Yeah.
A lot of good stuff.
Yeah. The newsletter goes into a lot more detail, different time patterns of charts, different support and resistance levels. So you definitely want to check out the newsletter this weekend also. And the walk and talk is going to be, you're going to want to read the newsletter and listen to the walk and talk for the newsletter.
Yeah, I always listen to the walk and talk. A lot of times I'm on my phone and it's hard to see everything, but I like you walking us through all the different charts and stuff. A lot like you do here on the show, right? I mean, it's a lot easier for me to just kind of listen. If I need to kind of zoom in on a chart to see what you're talking about, that's great. But I get a lot out of it just by listening to the videos. I think we got a lot of folks that like those, so I'm glad we started doing that.
Yeah. No, I think it helps a lot for sure.
Yeah, if you want to see what we're talking about. So normally our newsletters, it's about 30 days after they come out. They kind of go open to the public, right? So it's usually a month backwards. The last 4 weeks are only available to paid subscribers. But if you want to go back and look and see what those look like and see what we're doing each week, feel free. And you got anything else for us this week, Jerry?
No, I think we're good. We're hoping for somewhat of a recovery rally next week, and we shall see.
And I'm hoping you get a little sun down there so it can match up with your flip flops while the rest of us are freezing up here.
I understand. Apple tells me that it's supposed to be 11 degrees when I get back up there on Thursday.
Yay!
11 degrees.
Get ready for it. All right, guys, if you enjoyed the show, make sure you share it with your friends. If you have any questions for us, put them in the comments sections wherever you found this video, whether it's on Facebook, YouTube, Instagram, or LinkedIn. I don't know where else we put it. YouTube. All right, guys, hope you have a great week, and we will talk to you soon. We're out of here.
All right. Later.